Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing you want to do is simply just open up any equities underlying in your brokerage platform, and you want to navigate over to where you can see a list of expirations for that underlying. Any underlying will do. The purpose of this step is simply just to lock in on an expiration date that we can use to mock up positions. So the expiration date that we choose needs to be between 30 and 60 days out in time, and it also needs to be a monthly expiration, not a weekly or quarterly. So the only expiration date that fits that criteria is January 17th, which is 56 days away. So we could take that information, come over to our watch list, and simply filter out all underlyings that have earnings over the next 56 days. We do not want earnings to come along and disrupt our trade. Earnings will increase volatility, it will mess up our deltas, and these things will have a negative effect on our P&L. We also want to filter out anything that has a low liquidity rating level. So what you'll be left with is a list that looks something like this. Of course, it depends on what your watch list is. This is just a pre-made watch list. It really doesn't matter. We are product indifferent, and I personally like to list everything from high to low IVR. And the reason for this is because, of course, we want to be selling premium when volatility is high and then playing the contraction back down to the mean. First thing that has just come to mind is Save here. Trading has been halted for Save, which is very interesting. Very, very interesting. But nevertheless, so we just go down the list and we simply see what would fit well in our portfolio. Make sure everything's nice and diverse, use common sense, and you'll be fine. Coin seems to be looking very nice right now. It's trading at about $300 a share, 84.3 IV rank, and it has an absolute IV level of 99.9%. Right now, Bitcoin is making all-time highs, hence why we've got Coin and MSTR up here, doing fairly well. So if we go over to the trade tab for Coin, we can see we've got January 17th. This is the expiration date that we've already selected. And now we are presented with the options chain. At this point, we want to keep it very simple. We want to sell one call and one put. We want to sell them between 15 and 20 deltas. So we've got a 20 delta here at the 440 strike. And then we've also got a 20 delta here at the 240 strike on the put side. So 240 and 440 are our strikes. That's our range that we are playing at the moment. And we would collect $2,325 upfront in premium. Our broker is going to require just over 19.5k dollars in buying power. We've got a 68% probability of profit and an 86% chance of hitting 50% of max profit at some point over the next 56 days. We'd get a daily theta decay of $52. That would increase as time goes on, assuming all else is equal. However, $19,500, forgive me if I sound a bit blocked up. I am feeling a little bit under the weather at the moment. So $19,500 is probably too much for most people's accounts, which is fine. What we can do is simply buy another contract a little bit further out from our short contract, say $10 wide on the call side, and we can do the same thing on the put side, $10 wide. And what that's going to do is massively reduce our buying power requirement, because our loss is no longer unlimited. It is now defined. It is defined to the spread between the short and long minus the premium that we collect. That's how we end up with our max loss, and our broker only needs to hold enough money to cover the max loss in this case, which is about $660. So as we can see here, we collect less premium up front, but our return on capital is now much higher. And we do also have a slightly lower probabilities of success. So that's the trade-off. Now, if you want to know how much buying power you should be allocating to your positions, click the link in the description, click on free position sizing template, and then it will take you to this spreadsheet here. The way it works is you enter in the size of your portfolio at the top. You then enter in what the current VIX level is below, and then everything below that will be automatically calculated for you. All you need to do at this point is just use this information to form the backbone of your portfolio, and over the long run, you'll be absolutely fine. If you want to learn in more detail and see what we're doing behind the scenes, again, link in description. This time, click on EDS Premium. Get yourself signed up. Inside, you'll have exclusive access to our portfolios that will allow you to see what positions we're placing, how we're managing risk, and how we are making adjustments all in real time. There's a full course inside as well, so no prior knowledge is required. We will teach you everything you need to know. It is a private community, so you can speak with other like-minded individuals as well as myself directly. There's a 100% money back guarantee, so after 6 months, if you have gone through the full course and followed some of our trades, and at that point you don't know what you're doing or you're not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part. It is £1 a month to join right now. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And with that being said, I will see you guys on the inside.